A 21-year-old kid, barely old enough to rent a car, quietly outperforms billion-dollar hedge funds. No Wall Street office, no army of analysts, just a laptop, a trading account, and a strategy that shouldn't have worked yet somehow did. That's not supposed to happen. Hedge funds are the apex predators of finance. They hire PhDs, build algorithms, and spend millions on data feeds that track everything from shipping routes to satellite images of Walmart parking lots. And yet, in one corner of the market, a college student managed to beat them at their own game. Why does this matter right now? Because hedge funds are struggling. In the past decade, most of them haven't even beaten the S&P 500. Investors are asking, what's the point of paying 2 and 22% management fees, plus 20% of profits, if a kid with a Robinhood account can do better? Here's how the system works. Hedge funds promise alpha returns above the market average. They use leverage, short selling, derivatives, and complex strategies to squeeze out performance. But complexity doesn't guarantee success. In fact, it often hides risk. And when markets shift suddenly, those risks explode. Our 21-year-old didn't invent a new algorithm. He spotted something simpler: inefficiency. Hedge funds are so big they move slowly. They can't pivot into tiny opportunities because their size would distort the trade. But a small trader? He can slip in and out unnoticed. Think of it like a speedboat darting between cargo ships. The uncomfortable math is this: hedge funds manage trillions, but most of that money is stuck in strategies that barely outperform index funds. Meanwhile, small traders who understand niche corners options, mispricing, crypto arbitrage, even meme stock momentum can sometimes capture outsized gains. Not consistently, not forever, but enough to embarrass the giants. Here's the irony. Hedge funds often blame retail traders for distorting markets. Yet in this case, retail traders are exploiting the very inefficiencies hedge funds leave behind. It's David versus Goliath, except David is armed with Reddit threads and a brokerage app. But let's cut through the hype. Beating hedge funds once doesn't mean you'll beat them forever. Hedge funds have deep pockets, and when they notice a strategy working, they copy it, scale it, and eventually crush the margins. What looks like genius today can vanish tomorrow. Still, the bigger implication is unsettling. If hedge funds can't consistently deliver alpha, and if retail traders can occasionally outmaneuver them, then what are investors really paying for? Is the hedge fund industry just an expensive illusion prestige wrapped in jargon? And here's the risk. When small traders win, they often broadcast their success online. Others pile in chasing the same trade. Liquidity dries up, volatility spikes, and suddenly the system looks fragile. A single viral post can move billions. That's not how markets were designed to work. So we zoom out. This isn't just about one 21-year-old. It's about the shifting balance of power in finance. Technology has leveled the playing field. Information spreads instantly. Barriers to entry are lower than ever. And hedge funds, once untouchable, are being forced to admit they're not invincible. The story ends with a question. If a college student can beat hedge funds today, what happens tomorrow when millions of small traders, armed with better tools and faster networks, all try to do the same? Does the market become more efficient or more chaotic? That's the paradox. The more people who beat the system, the less the system can be beaten. And somewhere in that tension lies the future of finance.